After studying this module, you shall be able to, number 1, define risk in capital budgeting. Number 2, examine the importance of risk analysis. And lastly, number 3, understand the basic techniques of incorporating the risk factor in capital budgeting decisions. We shall commence our discussion by studying about the meaning of risk. Risk can be defined as the possibility of the actual outcome being different from expected outcome. Capital budgeting decisions are subject to risk and uncertainty. It is due to the fact that returns from an investment decisions occur over a long period of time in future, and future is quite unpredictable. We shall now move on and study how risk under capital budgeting is incorporated. In the view of capital budgeting, the term risk refers to the chance that a project will prove to be unacceptable, that is, where NPV is less than 0 or IRR is less than cost of capital. More formally, risk in capital budgeting is the degree of variability of cash flows. Projects with small chance of acceptability and broad range of expected cash flows are riskier than projects that have a high acceptability and narrow range of expected cash flows. Thus, risk should be considered while evaluating different investment proposals. There are several techniques available to handle the risk perception of capital budgeting proposals. These techniques differ in their approach and methodology. These techniques include risk-adjusted discount rate method, commonly known as RADR, certainty equivalent method, profitability distribution approach, decision tree analysis, and sensitivity analysis, etc. We shall now throw some light on risk-adjusted discount rate RADR. The use of RADR is based on the concept that there should be adequate reward in the form of return to firms which decide to execute risky business projects. Man by nature is risk averse and tries to avoid risk. To motivate firms to take up risky projects, returns expected from the project shall be adequate, keeping in view the expectations of the investors. Therefore, risk premium needs to be incorporated in discount rate in the evaluation of risky project proposals. Thus, RADR is a composite rate and has two components. A, risk-free rate. It is computed on the basis of government securities as these are considered to be risk-free. B, risk premium. It is the additional return that investors require as a compensation for assuming the additional risk associated with the project they undertake. By incorporating both risk-free rate and risk premium, RADR allows for both time preference and risk preference. Let us assume K represents the risk-adjusted discount rate, and thus the equation of net present value book looks like as follows. Net present value is equal to sigma ranging from 0 to n of net cash flows divided by 1 plus risk adjusted discount rate raised to the power t, where t is equal to 0. We shall now consider an example. An investment has an initial outlay of rupees 1 lakh. It is expected to generate cash flows for 1 year amounting to rupees 40,000 in the first year. For year 2, it will be equal to 50,000, where it is rupees 15,000 and 30,000 for the third year and the fourth year respectively. Risk-free rate of interest is 10%, risk premium is 10%. Solution: NPV using risk-free rate. Cash inflows for the first, second, third and fourth year are 40,000, 50,000, 15,000 and 30,000 respectively. PV factor at 10% is 0.909, 0.826, 0.751 and 0.683 for the first, second, third and fourth year respectively. By multiplying cash inflows with the PV factor, we get present value of cash flows, which is 36,360, 41,300, 11,265 and 20,490 for the first, second, third and fourth year respectively. Present value of cash inflows comes out to be rupees 1,09,415. Present value of cash outflows is rupee 1. Thus, NPV comes out to be 9,415. We shall now compute the solution using risk-adjusted discounting rate. Cash inflows for the first, second, third and fourth year are 40,000, 50,000, 15,000 and 30,000 respectively. PV factor at 20% is 0.833, 0.694, 0.579 and 0.482 for the first, second, third and fourth year respectively. By multiplying cash inflows with the PV factor, we get the present value figure of cash flows, that is 33,320, 34,700, 8685 and 14460 for the first, second, third and fourth year respectively. Present value of cash inflows comes out to be rupees 91,165. Present value of cash outflows is rupee 1. Thus, the net present value can be calculated by subtracting present value of cash outflows from cash inflows, which comes out to be 8835, which is negative. The project will be acceptable when no allowance is made for risk. But it will not be acceptable if risk premium is added to risk-free rate. It moves from positive NPV to negative NPV. If the firm were to use internal rate of return, then the project would be accepted when IRR is greater than the risk-adjusted discount rate. We shall now focus on the evaluation of risk-adjusted discount rate. This method has various merits such as A. It is simple to calculate and easy to understand. B. It satisfies the business persons who are risk averse. C. It incorporates the risk element. This method suffers from few limitations as well, some of which are: number 1, there is no objective basis of arriving at risk premium. Number 2, the assumption that the investors are risk averse may not hold true in respect of certain risk-loving investments. Number 3, cash flows are not adjusted to incorporate risk. 4, and lastly, The assumption that risk increases with time is not valid. We shall now study certainty equivalent, that is popularly known as the CE method. Certainty equivalent approach converts the estimated cash flows into certain cash flows using the certainty equivalent coefficients. The certainty equivalent coefficients is also known as risk adjustment factors and is denoted by N alpha. It is the ratio of certain net cash flows to risky net cash flow. Certainty equivalent coefficient A is equal to certain net cash flows divided by risky net cash flows. The discount factor to be used is the risk-free rate of interest. Certainty equivalent coefficients alpha ranges between 0 and 1 and varies inversely with risk. If risk is high, a lower alpha is used, and if risk is low, a high alpha is used. We shall now discuss this concept with the help of an example. A project costs rupees 50,000. It is expected to generate cash flows as follows. Cash inflows for the first, second, third and fourth year are 32,000, 27,000, 20,000 and 10,000 respectively. Certainty equivalent is 0.9, 0.6, 0.5 and 0.3 respectively for first, second, third and fourth years. It is risk-free rate of interest is 10%. We are expected to compute net present value. This is how the solution will be done. Cash inflows for the first, second, third and fourth year are 32,000, 27,000, 20,000 and 10,000 respectively. Certainty equivalent is 0.9, 0.6, 0.5 and 0.3 for the first, second, third and fourth years respectively. By multiplying uncertain cash inflows with certainty equivalents, we get certain cash inflows. Those are 28,800, 16,200, 10,000 and 3,000 respectively for first, second, third and fourth years. PV factor at 10% is 0.909, 0.826, 0.751 and 0.683 for the first, second, third and fourth years respectively. PV of cash flows is rupees 49,119. Present value of cash outflows comes out to be rupees 50,000. Thus, NPV comes out to be rupees 881, that is negative. The project has a negative net present value. Therefore, it is expected to be rejected. Evaluation of certainty equivalence. Although CE approach is conceptually superior to RADR approach, but it suffers from some limitations also, some of which are: number 1, the procedure for reducing the forecast of cash flows is likely to vary from one investment to the other. Thus, it would be inconsistent in such scenarios. Number 2, there are high chances that forecaster expecting reduction may inflate cash flows in anticipation. Number 3, when forecast passes through many levels of management, the original forecast may become highly conservative. Number 4, and lastly, because of high conservation In the process, only good proposals are likely to be cleared when this method is employed. Let us throw some light on statistical techniques. We shall commence our topic with probability distribution approach. This approach provides valuable information about the expected value of return and the dispersion of probability distribution of possible returns. However, it depends upon the behavior of cash flows being independent or dependent. A. Independent cash flows over time. The expected value of the probability distribution of NPV for any project is as follows. ENPV is equal to sigma ranging from 0 to 9 of expected value of net CFAT in period T divided by 1 plus risk-free rate of interest, that is I raised to the power T. The standard deviation of the probability distribution of net present values is equal to square root of sigma ranging from 0 to 9 of the square of standard deviation of the probability distribution of expected cash flows for period T divided by 1 plus I raised to the power 2t, where the standard deviation of the probability distribution of expected cash flows for the period T and is equal to square root of sigma ranging from 0 to n. PJT bracket start net cash flows for the time period T minus expected value of net CFAT in period T whole square. B. Dependent cash flows over time. When cash flows are dependent, the decision tree approach is used to get better results. Normal probability distribution. It is used to further analyze the risk in investment decision. A normal distribution can be standardized by calculating z-score. Number of standard deviation from the expected value of net present value is equal to outcome we are interested in minus expected value of net present value divided by standard deviation of probability distribution of NPV. Example, a company is considering an investment proposal costing rupees 7,000 and has an estimated life of 3 years. The possible cash flows for year 1, 2,000, 3,000 and 4,000 having probability of 0.2, 0.5 and 0.3 respectively. Cash flows for year 2 are 3,000, 4,000 and 5,000 having probability of 0.4, 0.3 and 0.3 respectively. Cash flows for year 3 are 4,000, 5,000 and 6,000 having probability of 0.3, 0.5 and 0.2 respectively. Assume that cash flows are independent and follow normal distribution. The risk-free discount rate is 10% and cost of capital is also 10%. Calculate number 1, net present value and standard deviation of probability distribution of NPV. 2. Probability of NPV is less than 0. Probability of NPV lies between 1500 and 3000 for point number 3. Solution. Cash flows for year 1 are 2000, 3000 and 4000 having probability of 0.2, 0.5, 0.3 respectively. We get expected value by multiplying the given cash flows with the given probabilities, and it comes out to be 400, 1500 and 1200. Now we will deduct the value of cash flow from the expected cash flow CF bar, which comes out to be negative 1100, 100 and 900 respectively. Now we shall obtain the square of the values obtained in previous step, which come out to be 12,10,000, 10,000 and 8,10,000 respectively. After gaining the square, we shall now multiply it with the given probability, which comes out as 2, 42,000, 5,000 and 2,43,000, total of which comes out to be 4,90,000, and thus standard deviation comes out to be 700. Cash flows for year 2 are 3,000, 4,000 and 5,000, having probability of 0.4, 0.3 and 0.3 respectively. We get expected value by multiplying the given cash flows with the given probabilities, and it comes out to be 1200, 1200 and 1500. Now we shall obtain the square of the values obtained in the previous step, which come out to be 8,10,000, 10,000, 12,10,000 respectively. After gaining the square, we shall now multiply it with the given probability, which comes out as 3, 24,000, 3,000 and 3,63,000, total of which comes out to be 6,90,000, and thus standard deviation comes out to be 831. Cash flows for year 3 are 4,000, 5,000, 6,000, having probability of 0.3, 0.5 and 0.2 respectively. We get expected value by multiplying the given cash flows with the given probabilities, and it comes out to be 1200, 2500 and 1200. Now we will deduct the value of cash flow from the expected cash flow CF bar, which comes out to be negative 900, 100 and 1100 respectively. Next we shall obtain the square of the value obtained in the previous step, which comes out to be 8,10,000, 10,000, 12,10,000 respectively. After gaining square, we shall now multiply it with the given probability, which comes out as 2, 43,000, 5,000, 2,42,000, total of which comes out to be 4,90,000, and thus standard deviation comes out to be 700. Determination of ENPV and standard deviation of probability distribution of NPV. ENCF for the year 1, 2 and 3, 3,100, 3,900 and 4,900 respectively. PV factor at 10% is 0.909, 0.826, 0.751 for the first, second and third year respectively. By multiplying ENCF with PV factor, we will get present value, which comes out to be 2817.9, 3221.4 and 3679.9 for the first year, second year and third year respectively. And the total comes out to be 9719.2. Cash outflow is rupees 7,000, and thus ENPV comes out to be 2719.2. We shall now calculate standard deviation of probability distribution of NPV. The standard deviation of the probability distribution of net present values is equal to square root of sigma ranging from 0 to 9 of the square of standard deviation of the probability distribution of expected cash flows for period t divided by 1 plus I raised to the power 2t. By replacing the values in the formula, we get 1073.7. We shall now find solution when probability of NPV is being 0 or less. Number of standard deviation from the expected value of NPV is equal to outcome we are interested in minus expected value of NPV divided by standard deviation of probability distribution of NPV. Thus, Z is equal to 0 minus 2719.2 whole divided by 1073.7, which comes out to be negative 2.533. According to table Z, the probability of the NPV being 0 is equal to 0.4943. Therefore, the probability of the NPV being 0 or less would be 0.5 minus 0.4943, that equals to 0.0057, that is 0.57%. We shall now calculate when probability of NPV between the range of 1500 and rupees 3000. Z1 is equal to 1500 minus 2719.20 whole divided by 1073.7, which comes out to be negative 1.13. Z2 is equal to 3000 minus 2719.2 whole divided by 1073.7, which comes out to be 0.26. The area as per table Z for the respective values of negative 1.13 and 0.26 is 0.3708 and 0.4803 respectively. Summing up, we have 0.8511, that is, there is 85.11% probability of net present value being within the range of 1500 and rupees 3000. We shall now focus on decision tree approach. Decision trees are diagrams to map the various investment decision alternatives and payoffs along with their probabilities of occurrence. The name of the approach derives from its close resemblance to the branches of any tree. This approach relies on estimates of the probabilities associated with the outcome of competing course of action. The payoffs of each course of action are weighted by the associated probability. The weighted payoffs are summed and the expected value of each course of action is then determined. The alternative that provides the highest expected value is preferred. Let us understand the approach with an example. Example A. A firm has an investment proposal requiring an initial outlay of rupees 40,000. The investment proposal is expected to have 2 years of economic life with no salvage value. In year 1, there is a 0.4 probability that cash flows after tax CFAT will be rupees 25,000 and 0.6 probability that CFAT will be rupees 30,000. The probabilities assigned to CFAT for the year 2 are as follows. The CFAT is equal to rupees 25,000 and probability is equal to 0.2, 0.3, 0.5. By multiplying these probability values with 25,000, we get the amount as 12,000, 16,000 and 22,000 respectively. If CFAT is equal to 30,000 and the probability is equal to 0.4, 0.5 and 0.1, by multiplying these probabilities, the values come out to be 20,000, 25,000 and 30,000 respectively. The firm uses a 10% discount rate for this type of investment. You are required to A. Present the above information in the form of a decision tree. B. Find out the NPV under worst outcome and best outcome method. C. And lastly, find out the probability or otherwise of the above investment proposal. Solution. Decision tree. If probability is 0.4, then CFAT is equal to rupees 25,000 and probability value is equal to 0.2, 0.3, 0.5. By multiplying these probability values with 25,000, we get the amounts as rupees 12,000, rupees 16,000 and rupees 22,000 respectively. We have three paths having joint probability of 0.08, 0.12 and 0.20. If probability is 0.6, then CFAT is equal to rupees 30,000 and the probability is equal to 0.4, 0.5 and 0.1. By multiplying these probability values with rupees 25,000, we get the amounts as 20,000, 25,000 and 30,000. We have three paths, namely 4, 5 and 6 having joint probabilities of 0.24, 0.30 and 0.06. We shall now proceed for computation of NP. For path 1, CFAT is equal to 25,000. Present value at the rate of 10% is 0.909. By multiplying these two, we get present value of cash flow, which comes out to be 22,275. Again, CFAT is equal to 12,000 and present value at the rate 10% for year 2 is 0.826. By multiplying these two figures, the present value of cash flow comes out to be 9,912. Total cash flows amount to 32,637. Cash outflow is 40,000. NPV comes out to be negative, that is 7,363. Similarly, we can calculate NPV for path 2, 3, 4, 5 and 6. Number 1. If the worst outcome is realized, the NPV will be rupees 7,363, which will be negative. 2. If the worst outcome is realized, the NPV will be 12,050, that is positive. Next, we can show the statement showing expected NPV. For path 1, NPV is negative 7363 and in joint probability 0.08. By multiplying these two, we will get expected NPV as negative 589.04. Similar procedure can be adopted for path 2, 3, 4, 5 and 6. Thus, total expected NPV comes out to be 3111.88. Yes, the project should be accepted since the expected NPV is positive. Sensitivity analysis. Sensitivity analysis or what if analysis measures the sensitivity of NPV of a project in respect to a change in one of the input variables of NPV. Following are the steps involved in sensitivity analysis. 1. Identification of variables that influence NPV and IRR. 2. Examining and defining the mathematical relationship between the variables. 3. And lastly, analysis of the effect of changes in each of the variables on the NPV of the project. Let us recapitulate what we have learned so far. Number 1. Risk can be defined as the probability that the actual outcome will differ from the expected outcome. Second, risk in capital budgeting is the degree of variability of cash flows. 3. Decision makers may employ conventional techniques such as risk-adjusted discount rate and certainty equivalent evaluation rate, while RADR adjusts the discount rate to incorporate risk. Certainty equivalent adjusts cash flows. Number 4. Statistical techniques may also be used to consider risk in investment proposals. The probability distribution approach proves to be a good technique when cash flows are independent over time. When cash flows are dependent, decision tree approach might prove to be very useful. 5. And lastly, sensitivity analysis or what if analysis measures the sensitivity of NPV of a project in respect to a change in one of the input variables of the NPV.